All right, good morning, everybody. We're live here, beautiful Friday morning, and I am super excited to introduce my friend and colleague, Mike Seeley with Ridgefield Partners. If you're joining us, this is going to be the first in a three-part discussion about selling your roofing or service business. And like any transaction, any significant milestone or event in your business or in your life, it's prudent to make sure that you're talking with experts and you're setting things up with a vision of the end in mind. So that's going to be the purpose of this three-part series. We're going to walk you through how to evaluate your options. We're going to walk you through how to value your business and some other best practices, some things you can do before you make these decisions that are so important and critical to your business and to your livelihood and your life. What you can do before, what you can do during that process, and what's important to do, after, and how do you maximize this value. So Mike is standing by, but it appears that he has just dropped out. So a little bit of a recurring issue here on my lives as we're newer to this process. Mike was standing by, and now he's disconnected, and now he's reconnected. So without further ado, I'm going to bring Mike Seeley with Ridgefield on, and we're going to have this great first part of this three-part series of discussions. So,
thanks, Dan.
Yeah, Mike, thanks so much for making time this morning.
Appreciate you having me. It's not a meeting until we have a technical issue. So
yeah, that's fair, and that's consistent with me posting this content here. I'm getting a lot of great feedback about the value we're bringing, but at the same rate, it's like every other time there's something either on my end or a guest end. So no worries at all. We're getting better every day. So Mike, again, appreciate you being here. I had the privilege of watching firsthand as you kind of went and are going through and looks like are finalizing this process with a company I do a lot of advising for, and I do a lot of this advising for roofing and service companies. So with that being said, can you introduce yourself and Ridgefield and the work you guys do?
Absolutely. No, again, I appreciate it. Ridgefield, we're a middle market focused M&A advisory firm. Most of what we do is sell side work. So working with, family owned, founder owned businesses when they're looking to have a liquidity event. So looking to sell their company for, whatever reason, often if there's, not a next generation that wants to run it or, for whatever reason, the shareholders are looking to get cash out of their business. We'll help them find, the right buyer audience, help them market their company to that audience, and then ultimately help advise our clients through, the negotiation and due diligence process, which are, really the critical points where you get a business sold.
Great. So are you, and again, we're going to kind of really work to simplify this. You used a couple terms there. What is middle market? What does that mean?
Absolutely. So middle markets, it's a really broad term. Really, how I think about it is anything less than $1 billion in transaction value. And at that point, it's really where you start getting what I refer to as sort of upper middle market or bulge bracket banks interested in taking on those mandates. So, if you own a $10 million roofing company, there's a lot of enterprise value there, but, the JP Morgans, the Goldman Sachs of the world probably, aren't the ones who are going to be the best transaction advisors for you.
Got it. So for those watching at home, so middle market would be, we're not a tiny company, but we're not a huge company. We're somewhere in the middle. Is that fair?
Absolutely.
Okay. All right, great. And then specific to the work you guys do is you guys aren't actually buying these companies, right?
Correct. So that's actually one thing about our firm is I'm super fortunate to work with a couple of partners here, Todd Harmon and Rich Warren, both of whom have actually, to your point, bought companies themselves before. And that was part of the whole reason that we founded Ridgefield was, for example, my partner, Rich, he comes out of, private equity. He spent 20 years doing, large $1 billion emerging market private equity funds, retired his family, or when he retired from that career, sort of moved his family to Denver, and he wanted to buy a small company and run it. And I think through his experience, just in some cases working with advisors to help look at selling businesses that he owned. There is a relative to the service offerings available when you're a very large company, versus the advisory options that are available when you're, again, say a $10 million services business. There seemed to be a disconnect in sort of the advice that was being offered, the way those processes are handled, and really trying to bring that upper middle market, bulge bracket type advisory experience to owners of these companies who are underserved by the advisory market, but again still have really great businesses that they've in a lot of cases spent their lives, their careers building. So wanting to honor that work and work with them to maximize the price that they get when they go to monetize that.
Cool. So the work you guys are doing, combining our new understanding of what middle market is that there's a very robust ecosystem with big banks and a ton of advisory services and people who advise these huge transactions. And what it sounds like to me is Ridgefield has really provided some of those great, best in class practices, but now you're doing that in an advisory capacity for these middle market companies. Again, not tiny companies, but not the biggest companies in the world. So a lot of my audience and people watching this who run roofing restoration businesses may find themselves there where they're doing a couple million a year or a couple tens of million a year. They're not, a household name nationwide, but what Ridgefield can provide is that kind of strategic advisory if they do want to sell the company. Is that right?
Absolutely. I mean, M&A, mergers and acquisitions, is every year there are thousands of transactions that people report on, billions of dollars of transaction value. The ones that you hear about on the news, those are often there's a handful of those get done every year, but the vast majority of M&A transactions are they occur in this lower middle market space, and again it's either strategic groups looking to add capabilities or scale to increase their own valuation, or if they're a publicly traded company, add incremental earnings, or in a lot of cases it ends up being a private equity backed business that they all have growth mandates. And so as far as there being a market for businesses like this, private equity is always a super active sort of segment of the buyer universe, just given the fact that they have a mandate to deploy capital. And so, not irrespective of market conditions, but kind of irrespective of market conditions, they have to get that capital out the door. And so,
cool.
Targets. Go ahead.
Yeah, no. So part of what I'm trying to do on these is kind of bridge the knowledge and information gap. And obviously, you and I have a nice relationship. And I have an MBA, and I've done some private equity deals, and I kind of live in this space. And I also live in the day-to-day advisory of roofing companies and handling claims and that sort of, I walk between those worlds. So what's interesting, I'm going to try to unpack that a little bit, and obviously step in and correct if I'm wrong, but there's groups called private equity. These are groups that have raised a bunch of money, and what their mandate is to buy, acquire interest, or completely buy private enterprises. That's why it's called private equity, and grow those so they can then sell them later, make a return to investors. So part of that business means that they are actively looking to buy businesses, right?
Absolutely.
Okay.
Absolutely. And the reason that a lot of, there's a strategy called, buy and build, in which, private equity will typically start with one company with, some meaningful scale. So typically between, call it $5 million and $10 million of EBITDA, moving to EBITDA, but earnings in a given year. And then once they have that initial investment, they'll go and add bolt-on companies to that platform. And cool. So they'll say they have a $10 million earnings EBITDA platform, and then they'll go buy 5 more that each do $1 million. And now you've got a $15 million EBITDA business, and those just through scale a lot of times command higher valuation multiples, again, which we can talk about. And so the private equity groups, they're well practiced at what we call multiple arbitrage. So again, buying a lot of smaller companies at say a 5 to 6 times multiple, and then rolling those into a platform that's valued at 12 times.
Wow.
And so again, that's the rationale on their end.
Cool.
And because the math works out for them like that, they're able to be very, very acquisitive. There's always private equity appetite.
Yeah, so this is really financial alchemy, right? So you're taking smaller parts, combining them, and they're worth, whatever those multiples, which we will get into as a smaller company. When you combine them into a larger entity, that entity not only makes all the money that these combined revenue and profit and all that good stuff, they're not just the sum of the parts, but they're actually worth significantly more because for a lot of reasons we don't need to get into, but because they have a bigger EBITDA, the multiple that a buyer will pay for these is actually even greater, right?
Absolutely. And one thing that I would say is that's why it's so critical that you pick, the right buyer when you're considering something like this, because, there's a huge quality spread in terms of how well these private equity shops are able to, integrate and then run these companies once they've accumulated a bunch of them. And then, again, when the private equity firm goes to exit, how well they were able to do that, how well they were able to systematize operations across the company, integrate all of the different operations, that will drive their price. And so, depending on the deal structure, if you have equity rolled or, things like that, you really want to make sure that you're picking a group that's doing more than just, to your point, mashing together companies because they all say roofing in the website. It's, it's a matter of finding, operating synergies, new capabilities, new, teams and new markets that, are able to fold into a larger organization. And again, there's a lot of work that goes on that integration front, and picking a group that, you as a seller feel good about working with is critical.
That's so important because some of these deals are structured where you're not taking a buyout of the whole company in cash. They're not saying, we use fictional Dan's Roofing. Hey, Dan, you've done great. You're doing $2 million a year. Here's a 6x multiple. Here's $12 million in cash. Go right off into the sunset. But some of these deals, they may give you buy out a portion of it. And there's obviously a ton of different structures. But a lot of times the seller will retain some interest in the entity. So the success of the overall entity will continue to allow that founder, that business owner who rolled into this platform to grow that investment alongside the bigger investment. So that's really cool to know. And this is where the strategy gets so important. And again, I'll throw you guys a bone because I've worked with you before, but just the highest offer is not always the best offer, right? We want to make sure we're looking at all the different deal points, but also the likelihood the deal will close, and also who that partner is, that if we're retaining some interest, that we are going to continue having this grow into the future. So I hope that kind of sets the foundation a little bit. And what I'd like to do now is kind of jump into some of the 101, the more basic questions, Mike, and we'll look at this like a semi-lightning round. We'll kind of do quick hits as much as possible, and then we'll dive in, where some clarification may be helpful. So the first thing I want to ask you, and your expertise is, understanding valuation basics, right? What does business valuation mean? And why is this essential, even if you're not necessarily selling now, to have an idea of how it works and maybe start thinking in terms of not just the money I'm making, but the value of the business?
Absolutely. So the enterprise value of the business is a big, complex term, obviously, but essentially it's the price, the top line price that an organization will pay for your business. How that enterprise value, to your point, is made up, the consideration mix, we call it, between cash, a seller note where you're carrying paper, an earnout or an equity roll. All those different things sort of factor into the enterprise value. But really, when we use that term, what we're looking at is sort of the headline price for all of the assets, all of the cash flows, all of the sort of piece parts of the business that are revenue and profit generating. And depending on how that's structured, either, again, an asset sale or a stock sale, there can be different considerations there. But at the highest level, EV is really
Okay.
what is my business worth.
So that's what the business is worth. And why is it important for roofing or service company owner, an operator, to think in terms of that and not just the money they're making on the short term?
Absolutely. Just, as far as operating a business and in this, sort of segment of the market, again, family owned, founder owned, reporting and financials aren't always necessarily, done to GAAP standards. And so, making decisions with an eye towards, or at least, an understanding of how a buyer will look at and evaluate your business is critical, because, every year you're putting financial performance and you're putting, behaviors really on paper. And so when you invite, a private equity group in to, look under the hood and look at the books, you want that story to be, something that supports you getting the highest enterprise value for your business. And so, thinking again, as you're making operating decisions affect that performance and that picture that you're painting, you really want to, again, understand sort of what the long-term goal is. And if it's maximizing enterprise value, then, you might run a business differently than, if the goal is to, pull out $1 million and drive a Ferrari every year.
Yeah. Yeah. And I'm actually putting a comment here because I love what you just said there is every year you are putting behaviors on paper. And I see a lot of these roofing guys, especially in the restoration, you have a hot market, a really great storm, and they go out and they buy depreciating fancy supercars and all this other nonsense, but they do it with company bank accounts and company proceeds. They're not really structured the right way. And without getting into that, because we got a lot to cover in this first segment, I love the idea of thinking it's not my personal ATM, right? The behaviors I'm essentially recording on a P&L or whatever, even if you're not keeping one, someone will at some point. The behaviors I'm doing, these are going to be recorded in the history of this company. And if my intention is to create enterprise value and not just take money out of this, personal ATM, essentially, then the prudent thing to do is to think with that end in mind. And a lot of what I talk about is always doing that, doing things the right way, documenting, having processes followed and held accountable for. So I absolutely love that. And I think, and I've seen it firsthand where operators, they'll make prudent financial decisions. So, company A will have the Ferraris and cigars every night, whatever, the symbols of success. And company B won't spend their money on that. When it comes time to sell, company B goes for a much bigger multiple. And even though the owner of company was taking more money out and looked like he was doing better financially, the owner of company B is the guy who pays off in the long end, and he makes a substantial amount more money than the guy could have ever pulled out when he does sell that enterprise. So that's a really hot button thing there. And I love that you brought that up, and I love the way you shared that. So when we talk about valuation, we're going to look at certain metrics in these businesses in order to understand what they're worth. The main one that gets kicked around a lot, of course, is this concept of EBITDA. And why is this considered to be one of the most important metrics in determining the value of the business?
Absolutely. So EBITDA is really a proxy for the cash flow and the earnings of the business. In this segment of the market, EBITDA is not cash flow, but understanding sort of how businesses are priced, people again often talk about it in terms of an EBITDA multiple. And so a part of our process on the very front end, one of the very first steps we do before taking a company to market is working with our clients and their accountants to really drill into that EBITDA figure. And we come to something called adjusted EBITDA, which is where we take, the book net income, we make add backs, definitional add backs to get to EBITDA, which is earnings before interest, taxes, depreciation, amortization. And then in addition to those definitional add backs, we'll go back through the P&L. And to your earlier point, if there are a bunch of personal expenses, a bunch of, maybe one-time or discretionary expenses that hit the P&L in a certain year, we will add those back to this adjusted EBITDA proxy. And what that is intending to do is to show, a buyer, if, Mike wasn't running the business like his personal ATM, what is the profitability of the company? And so getting to that number and again, making that number as high as possible is something that we spend a lot of time up front doing. And so again, in a personal, closely held business, that can be some, forensic accounting type work, going back and looking for, again, say there's a website overhaul 1 year that costs you 50 grand and you're not going to need to do it for 10 years. We're going to add that expense back. And then, we were talking about multiples earlier, call it 5, 6x. Every dollar that we can add back to profit, you're getting 5 to 6 times that in enterprise value. So that, $50,000 website expense can turn into, $300,000 of enterprise value, just based on how, again, these companies are typically valued.
So that's great. So again, trying to keep the big picture in mind for people watching who aren't in this world. So, we're going to come up with a valuation of the business, a fancy word for what it's worth. We're going to base that on some metrics, and we'll get into some other potential metrics, but it seems like the gold standard is this EBITDA, and it's the adjusted EBITDA is the work that you guys at Ridgefield and other, providers are going to come in advising companies on how to prepare this for market the right way, right? So, that's again another way where you guys can add value rather than a roofing company just going on its own saying, hey, we're for sale. They could enlist help from someone like you, and you're going to help them actually prepare these documents and kind of polish the business and get the maximized valuation. Is that correct?
Absolutely. Yeah, it's we hate making the analogy, but it is in some cases, similar to selling your house. You want to, clean it up. You want to stage it, take professional photos, make sure it looks nice. And then you want to get multiple people in there and have them sort of marching towards the same bid deadline. Have someone in the middle there, explain to all the different buyers, here's where we stand. And in a lot of cases, business transactions can be, emotional. In a lot of cases, it's, something you spent your life doing. I apologize here.
Yeah, no, it's all right. You can turn on the focus mode. Yeah.
Okay. As long as you can still hear me. I was saying that again, these can be, emotional processes. And so, having a group like us or really, again, an intermediary in there, that's looking at things from a third party perspective.
Yeah. Well, and I love the analogy you used. It's like preparing your home for sale, right? Because that's going to be something that most people are familiar with. Mike's dropped off again. We'll get him back on here, but this is a really good point to dig in anyways. So, when you go to prepare your house for sale, you can try to sell it yourself. You don't have a market. You don't have a background in marketing. You probably don't have a marketing budget saved up to market your home. You may need people to clean it. You may need repairs. You want to stage it so it looks great. You may want professional photographers in here to really market this thing to the best and fullest so you can get the highest valuation for your home. Same thing with your business. However, unlike a home where you or I could pick up a broom and clean it up, when it comes to a complex business, even a relatively simple business, you may not even know what the broom looks like, and you may not know where to sweep. Again, using that same silly analogy. So, all right, our man Mike's back here. So that was, Mike, I just kind of went further in on your analogy of selling the home. I know it's not perfect, but I do believe it's pretty apt. You want a high valuation on it. You do want deal points. You want your deal to close. And you want to prepare and stage your home, your business, for the highest value. Now, with a home, you might be able to take your own photos. You might be able to list it on Zillow or something, but when it comes to a business, if you're a roofing company owner, service industry, service provider, or home services industry business owner, you may not know what photos to take of the business. You may not know how to arrange the furniture to make it look great using that same analogy. So although it's not perfect, of course, I do believe it's pretty apt. And the next thing, can you hear me loud and clear?
I can.
All right, perfect. So the next thing I want to talk about is, I don't think it makes sense at this point to go in a discounted cash flow analysis or anything any deeper for 101. But how about comparable precedent transactions? How do you guys look at the market? How do you guys look at, we'll call it comps, to help determine the value of businesses? And just on the shorter end, because I know that one could go on forever.
Absolutely. So in their, at the highest level precedent comps are really, it's just looking around and saying, what did that guy get for his business when he sold? And so what we do when we start a valuation is we have, several databases where people report in these transactions. Typically the reporting is, the price paid, the enterprise value, and then the most current year's revenue and EBITDA performance, by the target company. And so transaction multiples, all they are is that enterprise value taken over and divided by either revenue or EBITDA. And from there you derive a multiple. On the revenue front, in roofing, it's, typically between, call it 0.5 and 0.75. So, apply that to your top line revenue, and that'll give you one data point. And then, on the EBITDA front, call it between 5 and 6. And you take that multiple and you apply that to your EBITDA. And that, there's nothing that's sort of shattering about multiples, but it really is, it's looking at, what if similar assets, similar size companies in my industry, what if those sold for in the past? And the goal is to get a sense for, what if rational actors looking at similar assets transacted at, and then, that sets it gives us the ballpark that we should expect valuation to be in. And then there's all the,
and I like
the drive value.
I like that, rational actors, because obviously in markets when they're in a mania or a rush to buy, or maybe you got a private equity fund that's focused.
And maybe I shouldn't have said rational actors, because sometimes it's, to your point, better to take advantage of the market when people are acting irrationally.
Yeah.
And what I would say, not that I think buyers in this space are acting irrationally, but I do think that, roofing, we talk about it with buyers, who have been in the home services space and been investing in these companies for a while. You often hear from them that roofing is sort of having its HVAC moment, which means that, there is a ton of private equity interest in these companies because the industry is so fragmented, and there are a lot of, sort of back end efficiencies that these groups can drive by, again, sort of to our original point, cobbling together a bunch of these businesses and bringing some scale, bringing, sort of systematized processes to bear. It's an area of the M&A space where we're seeing a ton of interest. And because of that, just through competition, prices are going up.
Yep. So that's the big picture, is the multiple stuff. And now if you're a thinking person, which we hope everyone watching this is, what you're going to say is, all right, so that's how we value the business, and kind of what we were talking about with EBITDA and how you strategically help prepare these companies for the highest valuation. You start thinking in terms of what levers can we pull to increase that multiple, or to increase the underlying factors that multiple is based on. And that's where your adjusted EBITDA came in. And that's probably, make an assumption, a lot of the work that you guys are doing in preparing these businesses, cleaning these homes up for sale, right? You want to get the clutter out. You want to make sure it's looking attractive. You might put some paint on it, some easy touch-up stuff just to show it in the best light. In preparing for a valuation, what are some of the common mistakes you've seen business owners make when they're trying to assess the business's worth, or as they're running these businesses?
Absolutely. I'd say that, again, there's a ton of answers there, but I'd say a couple that stick out are, one, I would say key man risk is a big thing in these small companies. In a lot of cases, the founder has been the driving force behind that business's growth. And, in most people's case, the instinct is, let's talk about all of the work that I do as the founder, all of the, sort of functions within the company that I perform. In the sale of the business, really, you want to hear the opposite. A buyer wants to hear that the founder is as disinvolved as possible, that they, have second and third layer management people that they can rely on, and that the founder can go and sit on an island for a couple of weeks a year and have it not be an issue, because ultimately what that buyer is getting is going to be the company absent that founder. And so taking steps in the years leading up to when you're looking at selling a business to really build out that second, third tier of management, empowering a COO or a general manager, getting your books in order is probably the other biggest thing.
Yeah, Mike, let me jump in there. So number one is, a lot of people beat their chest and say, oh, I do everything. I'm Superman over here. But when you're selling this business, you actually want to set up processes and systems and have team approaches with accountability. A lot of the stuff that we talk about generally, because when this business is going to be sold, if you're a key man is the term you used, right? The removal of that key man makes the business worth significantly less. And I'm sure that part of what these sophisticated companies who are buying these roofing companies, sophisticated organizations, what they're looking at is they're saying, when I give this guy a big liquidity event, when I buy half his company for 10 million bucks or 5 million bucks or $1 million bucks, whatever it is he going to take off? Is he still going to be working? Or do I need to replace that big element of the business that I just purchased?
Absolutely. And again, and the answer to that, depends on the founder, but in most cases, these buyers, they're going into this assuming that once they make, the seller wealthy, that, the fire sort of dims a little bit, if you will. So, again, putting in place as many things like contracts with suppliers, contracts with key customers, rather than saying, oh, I've got a great relationship with such and such. Well, the buyer is going to look at that and say, well, I don't have a great relationship with such and such, but, how do I know he's going to continue giving me, favorable pricing or what have you? And so, putting those things in place to give buyers, certainty of the future is really critical as you're planning for that sale.
Great. And so I think that, I just try to touch on some of these points that I see and I know would be valuable. What was you were going into number two? What was the second thing? So number one is that key man risk. What's the second thing that you'd point out? And we'll stop at three because we can do this all day.
All day long. No, so the second thing was really putting in some time and investing some money in cleaning up your financial reporting. Nothing kills a deal faster than unclean books or books that have to be, relitigated through accountants often. And so we spend a lot of time with our clients, depending on when we start working with them. Our preference is always, years in advance of the sale. So we talk to them about these sorts of things and how do they get, the business cleaned up so that it's saleable when we go to market. But yeah, again, the highest leverage thing I think that a business owner could do is, again, get a really clean set of books. In some cases, there's what's called a sell side quality of earnings report that you can do. It's typically, a $50,000 to $100,000 accounting exercise.
Wow.
But how we think about it is that, that $50,000 to $100,000, if they're able to go back in your books for 3 years, dig out, $50,000 to $100,000 of add backs of EBITDA adjustments, again, we're talking about 300 multiples of that in terms of return. And so, cleaning that up, giving buyers.
Mike, is that what you just talked about there, the sell side accounting there? Is that something that you at Ridgefield would help organize for people?
Yeah, we're not an accounting firm, but we have
you help them organize.
Yeah, exactly. There are groups that we've worked with, reputable CPAs and accounting firms that, that sort of scope of work is all they do all day long. And so, putting in front of the right advisors is another big part of what we try to do.
Cool. What's the third biggest?
Third biggest, I would say, and this is entirely self-serving, but I would say it's to run a disciplined process. We've got a saying that, if you've got one buyer, you've got no buyers. And again, back to the housing thing, it's good to have, and especially in this instance where, you really only get one shot at it. You want, as many people taking shots on goal as possible. And so the benefit of having, multiple qualified buyers at the table looking at your business on an apples to apples basis, and then being coached to, deliver to you, the seller, offers that are formatted a certain way that include certain things, and being able to evaluate those offers and, elements of each group structure that, maybe you like, the way that a note is structured on one offer and you want to, leverage that to another offer. That whole competitive process is probably the third way I'd say is.
Yeah. And I love that. Again, I think if we break this down into simplicity as something that many people have done, or at least can understand conceptually, is if you're selling your home, if you've got one person putting an offer in, the market for your home is take it or leave it for that one offer. If you've got a really robust process, what you said, a disciplined process to assemble bids, to put this business out to market. And it sounds like that's the work that Ridgefield does. And I know it is the work Ridgefield does. So now we talk about having this disciplined process. We've cleaned up our books. We've tried to eliminate as much key man risk as possible. We've gone back through the process with your help, with the accounting's third-party accountant's help, and we've added back in adjustments so that we can get a multiple based on that money we put back into the books. Then we clean it up. Then we're going to market, through this process with a really shiny, beautiful, well-marketed, well-positioned asset. You're going to get higher valuation, but you're going to get higher quality deals as well. You're going to get better deal composition. You're going to get more sophisticated, better entities that are interested in buying your organization. And that'll mean if you hang on to some equity or you've got some other incentive pay or whatever it may be, that this entire deal, although even if the valuation on day one isn't as high, you're going to make a lot more money. Also, you're going to be a lot happier because your deal's going to go through, right?
Absolutely. You put that better than I could. I mean, certainty to close is critical, and there's never certainty, but having backup plans, I guess, is maybe the next best thing. So, again, to what we've been saying, if you've got one group making an offer, you're entirely beholden to how they're looking at things. You don't have any frame of reference or context for how other people look at things, and so
that's great. Yeah, I think too, part of that might be because I'm a lawyer. I see deals that don't close every day and I'm litigating them to make them work.
Exactly.
So that may be just based on where I'm coming from. That deal strength and certainty to close is something that I would value pretty high, especially if you're spending all this time and effort going through this process as a small business operator, which I am one of those as well. If you're going to spend 5-10 hours a week for 6 months doing this deal process only to find out it doesn't close because you didn't want to spend 50 grand to put your books together, like you're going to be in for a cold shower is the technical term. So this has been really helpful, and even just talking through it and thinking about it out loud with you here has been really good. So that's the three biggest kind of issue deal points. Let me, what I want to do here is, we got a little more of your time. I appreciate you being generous, sharing your time with us. What are 3 points, kind of like as much as possible, specific, actionable, that if I'm a roofing company owner and it's a family owned affair, or I'm the owner operator and I'm doing well and I've grown my business, what are the kind of the 3 biggest tips? And they may overlap a little bit, but what are the 3 biggest tips if you're saying, if Dan's Roofing calls Mike and I say, hey man, I'm really early in this process, but I'm interested in hearing about what it would look like to sell Dan's Roofing, fictional company. What would the advice you'd give that person be?
Absolutely. In addition to the 3 things we said earlier, I'd say, actionable, things that you could do today. I mean, having a CRM that's well built that, is tracking performance of, key sales reps, where are you getting leads from, or how long is it taking you to, close, bill, and deliver those projects. Providing as much insight into, the business from a data perspective as possible, because again, that's how a lot of these buyers internalize information is, can you prove it out through data? And so again, having a well-developed CRM, or at least again, documented processes about how you do things with the key metrics tracked is critical. Another thing I'd say is, having a good transaction team and working with advisors that know and have sort of been talking to over a number of years about potentially selling your business. And so, we are brokers in the sense that we help, again, clean up companies, help match them with potential buyers. To get a transaction done, you need to get a deal attorney. You need an accounting team who's going to probably help respond to the buyer's QOE, quality of earnings requests. And so making sure that you've got the right team built around you. And the third thing, sorry, I'd say is a tax or a wealth planner. And again, as far as maximizing value, enterprise value is great, but what's better is, take home proceeds. And so working with a wealth manager or a tax advisor who's specifically, it's sort of like medicine. We always say you want to work with a wealth advisor who specializes in pre-liquidity, pre-M&A planning, rather than, say a generalist who can help you pick stocks. There are a lot of mechanisms, I'll say, that, someone expecting a large cash windfall, through the sale of the business that they can put in place, depending on the runway that wealth manager has, whether it's 5 years, 3 years, 1 year. There are devices that can be implemented to help, shield those proceeds from taxes. And so,
I think that's
that team is critical.
And the other thing to note on that is some of these are one-way doors, right? Once that transaction closes, you can't structure it in a different way to maximize your take-home, income.
Maybe one thing we could do, and I'm just spitballing here, Dan. Maybe we could have a wealth manager, and there's several that we can talk about this offline. But
Sure.
Some of those, just getting somebody on to talk through some of those strategies, because to your point, exactly, like they're gifting trusts and all sorts of things that.
Wow.
That if you've got heirs, and again, this is not financial advice. I'm not a wealth advisor, but there are all sorts of trusts and things that can be structured. And if you gift certain shares in your company to your kids, your grandkids, whatever, those types of things can be set up. But again, in a lot of cases, they can't be undone. And so, working with someone who understands your financial picture holistically, understands your, personal goals and family and lifestyle and all that. That's all critical.
And Mike, that is a perfect point to kind of just, wrap up this kind of early basics 101 discussion. We covered a lot today, right? So we covered understanding valuation basics. We've covered EBITDA, what it is and why it's important, precedent transactions, preparing for a business valuation and how you can, best go about that. Attracting buyers, marketing the business the right way, working with experts, and then finally maximizing business value. But what you keyed in on there, which wasn't on the agenda and I didn't expect it, but it makes all the sense in the world, is maximizing the impact of why you're doing this. You're not selling the business so that the business has the highest dollar figure possible. You're doing it so that ultimately what you're taking home is maximized, right? And that's, I'm sure, a lot what you go through with these different deal points is, that's what, there's sayings about what revenue is versus what profit is, right? And, revenue is a vanity metric and that sort of stuff. Ultimately, what you take home at the end of the day is your profit or your,
ours is you can't eat EBITDA.
Yeah.
That's our thing.
Yes, not even adjusted EBITDA.
Exactly.
So, well, Mike, I really appreciate you making time. I know the audience got a really, some great stuff today. Where can people find you to follow up?
Absolutely. No, really appreciate you having me, Dan. You can find my contact info on our website. I can also share it with you. And I don't know if there's a way to get that out to the audience.
Yeah, we've got it posted in a bunch of stuff too. Perfect. So we'll make it easy for people. And what would be the right person who should reach out to you? When should they reach out and who should reach out?
If you own a roofing company and you are considering selling it ever, please reach out. Our preference is to, again, as I said, start working with people as early as possible, because that's when you have the most, optionality and opportunity to really, again, do some things that can help grow the enterprise value. And again, I'm pretty young. I need revenue today. I need revenue 10 years from now. So, let's get in touch.
Cool.
We be a resource to anybody in your orbit who's thinking about this, and whether or not they do something. Always happy to talk to people in the space.
Excellent. Well, thanks so much, Mike. We'll make sure to post that. We'll get our next talk scheduled. You and I will brainstorm some really cool ideas and what could add the most value to people who are maybe looking at potentially selling, even if it's not today, 5 years, 10 years, 30 years down the line. So we'll look towards that in our kind of 201 session. This was our 101. So again, thanks so much for making time. I'm going to do a little wrap up, and then we'll reach back out to setup number 2.
Awesome. Thanks for having me, Dan. Nice talk.
Cheers. All right, guys. So that was Mike Seeley with Ridgefield. Good guys. Like I said, I've had some direct experience working with them. Like marketing a home, marketing your business is a process. And it sounds like from this discussion and from my experience, the sooner you get engaged with people, even just in an advisory capacity, to know what you should be doing if you may eventually want to sell the business. And I would think that it makes sense for anyone who owns a valuable asset like a business, especially if you're a founder and you've got a family, or you eventually someday want to retire, right? You don't want to work up to the day you die. You don't want to die on a job site. It makes sense that you will eventually sell this asset if it's a valuable asset. So even if you're not in the market, if you're not looking to sell today, tomorrow, next year, 3 years, 5 years, it probably makes sense to take some of the advice we covered today and apply it to running your business. And also, too, it sounds like Mike's open to talking to people. I know what I would do if I own a roofing company after listening to this. And from my experience with Mike, I would reach out to him just to start the talk, start the dialogue, and start learning what I should be doing at this stage in my operations. So I hope you got a lot out of this. Please leave some comments, DM. We get a lot of interaction after all of these sessions, which we really appreciate, because it helps me know what you want to hear. So that was our 101 session, our first in our 3-week series here. We do have the holiday next week, so we're going to see when we schedule that second session. And we're going to keep kind of just like like an educational course. This was 101. This was the basics. Next week or next session, we're going to step it up a little bit and getting more actionable, diving in a little more advanced. And then finally, the third series, we may, I'm just thinking now, we may have someone who's gone through this process join us to talk about what it actually looks like. So if you're a roofing company owner, you can listen to a discussion from someone who literally sold their roofing or service company through this process, what it was like, what they expected, what it actually looked like, and any advice or tips they have for you. So appreciate you as always joining. Feel free, fire away in those comments and those messages. Let me know what we can do more for you. And everyone have a great weekend.